Well, the policy statement has been digested well, and amongst the key highlights, you could argue that the thought around how global policy rates may stay higher for longer, or the move on the ICRR, and a couple of other points stand out. Without much ado, let me get in a very special guest to try and understand what his thoughts around the policy were. Mr. Rajiv Anand, Deputy Managing Director of Axis Bank, joins us right now on the show. Rajiv, it's been a while. Thank you for taking the time out. Much appreciated. What stood out in the policy for you, may I ask?
Thank you, Neeraj, for having me. Yes, it's been a long time. I think the policy was really on expected lines. What did the markets expect? Markets expected that they were hoping that the RBI will see through the tomato inflation. The market knew that there was about 250,000 crores of surplus liquidity sloshing around, and so they were trying to figure out what the RBI would do as far as this excess liquidity is concerned. And I think therefore to that extent we got the incremental CRR coming through. The good news is the total impact to the banking system is that it takes out about 1 lakh crores for a period of about 1 month. I think the review is on 8th of September. So therefore I think that it's a good move. It's a short-term move, and I think to that extent the fact that the policy measure, the rates have been kept stable, A, and B is there's been the short-term measure around liquidity is something that I think broadly speaking was expected. The fact that we have seen them redo inflation numbers quite strongly over the next 9 months or so, I think is a bit of surprise. And I think what it clearly means is that any expectation of a rate cut is now off the table, at least till 31st March 2024. And therefore, we are going to be in a higher for longer environment. And I think that is something that we need to reconcile ourselves with.
Yeah, I mean, global policy rates plus the fact that they said that we hope that the food inflation goes away. No clear certainty out there. A couple of things, and one question from my end, it was whether this liquidity, gosh, I mean, when you've taken when the move's been taken to withdraw 2,000 notes, you would expect that would come into the system. So in that sense, should it have been preempted? And is this ICRR, usage of ICRR, a bit of a surprise? I mean, ideally, it should have been preempted that something like this will happen.
I think, no, it's a fair point. And I think the way that the RBI governor explained this is there are multiple choices. I mean, you can easily use VRR, etc. The RBI had multiple choices in front of them. They felt that the incremental CRR is the best option at this point in time. I've been around in the markets for a long time, and this whole thing around incremental CRR, etc., just complicates calculations a bit. And I remember having complex Excel spreadsheets as a result of that. So it just brings back a bit of a deja vu because RBI over a period of time has simplified CRR calculations, and to that extent they're just going back a bit on that. But like I said, it's a temporary measure, and nothing that should trouble us too much.
Mr. Anand, a little bit more on the incremental CRR. What's the expected impact? Would it be fair to say that short-term rates are now expected to see a little bit of an uptick? And adding to that, would it also be correct to say that bank balance sheets are likely to see minimal impact considering it's a short-term measure?
Absolutely. The total impact, I mean, in revenue terms, let's just look at the numbers. It's about 1 lakh crores is the impact, like I mentioned to you, for about a month, assuming that that money would have, under normal circumstances, been put away in overnight liquidity at 6.5%. That effectively means that you're talking about 500 to 600 crores of impact for the entire banking balance sheet. So therefore, to that extent, there is going to be an impact on liquidity, but not. I mean, there is no material impact as far as bank P&Ls are concerned. Yes, we should expect a little bit of an uptick in terms of the very short-term rates. But remember, the system is still surplus, and so therefore that uptick is not going to be significant.
Okay. Rajiv, there was a fair degree of conversation around the Vostro account and, where is the refined rupee, if you will. I'm just trying to understand. Do you have thoughts here? Because, I mean, there were 4 or 5 questions directed at the Reserve Bank of India. Maybe they can't say, but they didn't kind of give out an exact answer of any measure whatsoever, not even about the expectations that the market has with regards to this. Do you have any thoughts here? And could there be an issue of sudden withdrawal of liquidity that could happen, or would it be very measured because it's a trade between nations and doesn't quite happen overnight?
It doesn't happen overnight, Neeraj. This is money that has gotten built up over a period of time, and let's just say that much of this money has gotten built up thanks to the geopolitical situation that we are in. There is no clarity on how much that money is, when that money is going to leave the system, if at all, and how that is going to leave. And so therefore, we'll have to work through this as we go forward.
Okay. I have one question. Maybe Pallavi is more, but I have one more question for you, Rajiv, and that is, the worry that maybe even the risk asset markets have around what China does. The Reserve Bank of India was asked about Chinese deflation slowdown, and I think I heard Mr. Michael Patra say that as of now, it is not even a recession, maybe a bit of a growth slowdown. IMF predictions of 5.2, which is maybe lower but not bad. You, as running such a large successful bank, are you concerned about the data emanating from China? There is a lot of chatter on the last 2 days around the property sector in particular, and how it could even dwarf what happened when Evergrande happened. So any thoughts that you have particularly on this?
I would look at it in multiple ways, as someone working in a bank. One is the impact on our corporate clients, and I think by definition, the fact that China is relatively weak should, by definition, mean that any pressure on commodity prices is unlikely, and so therefore, users of global commodities may not necessarily benefit, but will not get impacted. Yes, there could be some impact on commodity companies at this point in time, and we'll have to, like I said, just figure out how this is going to play out. I think ultimately, from a geopolitical and geo-economic perspective, the playthrough really is through global flows. And I would imagine that as China, continues to weaken, or some of these data points come out on a month-on-month basis, which are sort of relatively weak, I would imagine that India should be a beneficiary, because on the other side, I think growth in India will continue to be strong. You heard RBI today say that growth should be in the vicinity of 6.5% for the current year. I think in the context of where we are globally, I think those are very strong numbers. Yes, there is a bit of worry about inflation, but it's not anything that is untoward, at least at this point in time. And so therefore, from a global flow perspective, we should certainly benefit, and that once again is good for the rupee. And so therefore, relatively weaker commodities and stronger flows should mean that either we will see strength on the rupee, or the RBI comes in and intervenes, which means that liquidity will continue to be relatively easy as we go forward.
So, Mr. Anand, we did touch upon growth indicators looking up at this point domestically. I do want to ask you a little bit more about what the corporate loan book is looking like. And the reasons at this point, despite the optimism around private capex, I think it would be fair to say that it's government capex that's actually leading Indian growth. So, what's the corporate loan book looking like in terms of capex?
Our own estimates is that bank credit will probably grow somewhere between 13 to 15% this year. But within that, we are certainly seeing a very good growth on the corporate side, and it is well diversified across multiple sectors. Part of it is working capital, part of it is refinance, part of it is private capex, and we are having multiple conversations with our customers about capacity expansions. But I must also say that corporate balance sheets are in probably the best shape that we've seen in a decade, and I do see an element of aversion to leverage within the corporate community, which means that yes, they are increasing capacities. There is the confidence to increase capacities, but in many cases, they are using their own internal cash flows to be able to support this capex. Only a small part of it is coming to bank credit. But I think, but I can say with a great deal of conviction that that the private capex cycle has well and truly kicked in. Yes, it can certainly get much better, but it is certainly much better than what we've seen, let's say, over the last 3 years.
Sorry, just a quick follow-up, Rajiv. Tempted to ask this to you before we wrap up. In your experience, having looked at multiple cycles, do you reckon it's sooner rather than later that private sector comes looking for bank credit as well? Or is it difficult to say at this point of time based on what you just said?
I think what you're going to see is that corporates will use different instruments to fund their long-term growth. And so therefore, banks like us, it's very important for us to be able to support them across the capital structure. So if they want equities, we should be able to raise equities for them. If they want to raise bonds, we should be able to help them. And we are very happy to provide our balance sheet to support them with their growth. And so therefore, to answer your question, I think increasingly large corporates will use some part of their growth requirements through banks, but they will also use both local and domestic bonds, for their requirements. But as you go lower into mid corporates and SMEs, they will predominantly be funded by banks. And you are seeing, for example, for us, if you look at the MSME and up to mid corporate, which is basically companies up to 1,000 crores, that book is granular, is well diversified geographically, sectorally, and is growing in excess of 30%. And it's not a small book. We really like that book because of the fact that, like I said, it is well diversified in terms of risk. And so therefore, there are certainly pockets of opportunities within the mid corporate and SME space, and there will be opportunistic opportunities in the large corporate space.
Lovely talking to you today. Thank you so much for taking the time out and giving us a lowdown on multiple things, not just the policy. Appreciate your time.
Thank you so much, Neeraj.
Pleasure was ours. Well, viewers, so that's Axis Bank with their views on policy. No surprises thereof. And Olivia, I thought the fact that he said that, I mean, the important point that comes out from the policy, amongst other things, is that any kind of rate action from the Reserve Bank is well and truly ruled out for FY24 at the very least. We take it a quarter from there and figure out what happens. At least until then, we're not seeing any kind of rate tinkering from the Reserve Bank of India as things stand.
Absolutely. I think one of the key takeaways from today's policy has been higher rates for longer. Up until recent days, even up until the policy, I think there was a little bit of division between analysts and economists as to whether a rate hike could happen possibly at the end of this year or in the fourth quarter of this fiscal. After today's policy, I think the central bank has reaffirmed that there's a greater chance that a rate hike is off the cards in FY24.
Okay, well, let's stick to policy and get in Tanvee Gupta Jain. She joins in right now, as she did in the last policy as well. Tanvee, it's a pleasure talking to you yet again. Thank you for taking the time out. What stood out for you?
I would say the policy was largely on expected lines. Rates were kept unchanged at 6.5. Growth forecast was kept unchanged. We were highlighting there is a 30 basis point upside to inflation, and RBI went ahead and revised the forecast from 5.1 to 5.4. But I think two things which kind of stood out. One, you can clearly see that MPC remains vigilant on inflation. I mean, very clearly, the RBI governor reiterated that the commitment is to align CPI inflation to the 4% level on a durable basis. And if you look at, I know the entire market was worried about vegetable prices leading to higher CPI inflation, which in our forecast are also showing that the months of July and August, my inflation will be trending towards or in between 6 to 7%. But I think one very strong statement which kind of RBI governor clearly highlighted, that we do look through idiosyncratic shocks, but if these shocks show signs of persistence, we have to act. So in case these one-off inflationary pressures became more generalized, I think RBI is kindly saying that my focus is inflation and I remain vigilant. So I'm nowhere near dovish, and nowhere I'm saying that, whatever happens and I'm going to stay put. So I think that was interesting. The second interesting thing was definitely on this incremental CRR. We know the system liquidity is around $21 billion before this mark or before this measure which was announced today. And clearly they have highlighted, at least RBI governor clearly highlighted, that they will be, they will be able to absorb the surplus liquidity generated by various factors to the tune of around $12 billion, very similar to the number we came out with. I think that is something which surprised the market more than the rate this season today.
Tanvee, I would like to delve a little bit more into the food inflation dynamics. Like, for instance, the RBI now forecasts Q2 CPI inflation at 6.2% compared to its previous forecast of 5.2%. That's a sizable upgrade to the forecast, right? So food inflation, there's a lot happening even within each commodity. What's your view? Do you think there are greater risks of stickier food inflation?
Okay. So what a very interesting analysis which we did, we looked at, we actually studied a month-on-month price momentum across all vegetables, which come under the CPI vegetable category over the past 10 years. And you realize that CPI vegetables alone has almost a 6% weight in overall CPI. And when I look at the data, you will see that almost all vegetable prices show this upward momentum in the month of June and July. They peak out in July, August, and they actually begin to decline significantly in the month of September onwards. Normally, we have seen that tomatoes, which is the biggest culprit this time around, cropping season for tomatoes is only 2.5 months. So you will see that there is a clear seasonal pattern between June and July, because this time, because of uneven monsoons, we did see that the crop output got damaged. My expectation is you will see the supply hitting the market and tomato prices will begin to correct from the month of September onwards. Again, if I look at the categories of vegetables available within the broader CPI heading, I realize that most of the vegetables will show a moderation from the month of August. Onion prices is something that could actually normally, if I look at past 10-year data, they normally end up surging in the upcoming months after the tomato prices. This year, if El Nino actually strengthens pace from September, which most of the weather agencies are kind of predicting, then what you will see that unseasonal rainfall, which you have seen in the past few years, that every time during the months of October, November, you get unseasonal rainfall and vegetable price hike again happens. I think this time you might be lucky that you may not see that spike in vegetable prices, which you are seeing right now. So in that sense, yes, there is a very significant revision in the September quarter inflation forecast. But I think if the weather conditions remain in our favor, you will see that correction happening very significantly from the month of September onwards.
Okay. Well, let's get in Jayesh Mehta in this conversation as well. Jayesh, great having you. Thanks for taking the time out. Just talking to Tanvee about her thoughts on what stood out and inflation. Starting question to you: what was the standout feature for you in the policy? And a word on this whole conversation that happened around the Vostro and the Rupee and the liquidity and the fallout from that, if any, if there is a sudden reversal.
Hi, thanks. So I think maybe let me start reverse way around, right? On the Vostro, so while we may keep on saying that it's been permitted to keep in India and people are using that or not using that, they were silent on it. But as also Deputy Governor Ravi Shankar said, right, what makes you think that balance is lying in Vostro? Because it's a trade surplus, right, which is anyway going out for expenses for our other imports and stuff like that. So from that perspective, that's one part of it. So I would not worry too much on the Vostro, nor our guess, US market does think that they were buying GSEC and all that. Our team's guess is not much they have done in GSEC. So from that perspective, I would not really look at it. And again, at the end of the day, we don't have any bilateral with Russia. So whether it's rupee trade or AED trade or yuan trade, how does it matter? It's ultimately not going to be foreign currency neutral, right? So from that perspective, I would kind of ignore that and see as and when it comes in. As far as today's policy is concerned, everything was as per the expectation, except for the new CRR situation. And I take this slightly differently because, and I think I'm again reading between the lines, this is purely my interpretation, that there was a challenge that banks are not using 14-day repo. RBI had consciously in the last 4 years or so moved to 3 years or so moved to 14 days repo, and they want to keep it that way rather than tinkering daily and 3 days and 4 days and 5 days. I think there is also a behavioral situation where he also mentioned before saying this, that there was, in 14 days, people don't put in money, rather they would try to put money at STS at 0.25% lower. It's purely behavioral because, and there are reasons for that behavioral thing, because in the past there have been questions that while you're lending 14 days to RBI, why would you borrow? Because in between you might have a different situation and you might have to borrow. So nobody wants to really take a call more than 3-4 days. And maybe there was no other alternative. Otherwise, they're very clear that 3-4 days, they don't want to bring it back again. And maybe that's the reason they went for the CRR. And again, it's temporary. Again, this liquidity which came in because of 2,000 rupee note was kind of not planned activity in terms of the surpluses. So that has to be sucked out, and that's the right thing to do.
So, Mr. Mehta, what do you expect will be the near short-term impact of the measure? Also, while short-term rates are expected to remain slightly elevated following today's announcements, is there any impact we can expect on broader bond markets as well?
Not really. I think it's just first day reaction. Yes, the only thing impact would be on the equity side, on the bank equity pricing, but I really don't see much impact on liquidity or bond pricing. Of course, short end did move up a little bit, but beyond that, I think it is just a question of another 3-4 days for it to settle back down.
Okay. Well, Tanvee, can I get you in on the inflation piece once? And that is the point that one, global rates higher for longer noted by the Reserve Bank of India. Their own statement suggests hikes or other cuts are out of the window until FY24. This on the food inflation, they said that everything else was aligned. Food was where the shock was, and we hope. Twice did Michael Patra say that we hope that it passes through, but we are also hitting a busy festive season in circa couple of months. What is your internal assessment? Do we kind of peter down at some point of time, or there are jokers out in the play because of food, because of China, and so on and so forth?
So a couple of things from the inflation perspective, the way I will be watching out inflation going forward and things which I will be monitoring. Obviously, we need to take into account while summer crop sowing has been fine so far, it is largely flat, rice has picked up. We are seeing that there is a lag in the pulses production. Second, if El Nino actually strengthens pace, and we know our winter crop is largely irrigated, but what if you end up getting a very dry winter, which can have an impact on wheat where we don't have enough buffer stock of wheat? And the third, I would say, I mean, we are in a pre-election year. What if there is a pickup in populist spending ahead of tight election calendar? I mean, we have 5 states going for elections in November, December. We have parliamentary election next year. So I think all these factors will have a bearing on how inflation pans out, not only food, but overall how inflation pans out. I mean, we are lucky that core inflation is actually very reasonable and comfortable. A lot has to do with even the global supply side bottlenecks which have eased, which is actually helping in bringing down core inflation. So right now, I would say most of the upside risk in inflation which has come up, say even that 30 basis point which you're seeing is purely on account of food. When we looked at our inflation trajectory, we have not really revised so much on my core inflation numbers. So, but I think as I was pointing out, any populist spending by the government closer to election, that's a risk which we have to monitor very closely. And what if we don't end up getting a very good wheat output next year, especially in a year when you have elections around the corner, and plus there are geopolitical uncertainties which is having an impact on global food prices. So that is something I think from an inflation point of view very important to monitor going forward.
Tanvee, as a follow-up to that, so I would like to know what's your inflation forecast for the figures coming up on Monday. We've seen a fairly wide range, ranging from anywhere over 6% to maybe a possibility that inflation figures for July might actually exceed 7%.
Okay, so as of now, my forecast for July is 6.5%. And we do actually make our forecast based on real-time data for whatever food segments, vegetables, cereals, pulses. So whatever are the actual data, whichever is available of the basket of food commodities that we have already taken into account. So it is coming somewhere around 6.5%. For the month of August, my inflation number will remain elevated. But again, I will take the real-time actual numbers into my calculation to see whether it is actually going closer to 7 or the number is going to be slightly, somewhere between 6.5, 7. But as of now, I'm still in the camp that 6.5 looks like a much more reasonable number for the month of July.
Okay. Jayesh, one final question. I mean, for a lot of people, the ICRR or the incremental CRR was the key announcement per se in a policy which, as Tanvee said, was largely on expected lines, and I believe you would think so as well. Would that be your assessment, and is there anything else that stood out for you? And also a follow-up is there on what's your assessment of whether the rupee stays stable with the RBI's efforts, so on and so forth, or do we see a bit of a slide because the dollar index, after kind of weakening a little bit, has again showed some signs of strength?
No, except for ICRR, which people found it surprising, but I take it differently. I think it's just to maybe impress upon the behavioral. So maybe once the behavioral changes, we might not have to in future resort to this kind of situation. That's one. In terms of currency, yeah, it's become very range bound. Looks like 83 will be defended, so there is no question about it. Though we are very close to 83, if it is broken, market expect that to go to 83.60. But as of right now, doesn't look like. And he also did use the word. We have got the umbrella back, right? So, and in what context he talked about the umbrella, and he also clarified this. I'm not talking about monsoon umbrella. And in his one of the previous speech, did say that you have an umbrella to be used for rainy day, and I think they will continue to defend unless you see some really major outflow. Dollar strengthening, DXY strengthening dramatically. That's a very different situation. But it doesn't look like from particularly from our friends in equity markets and other markets, right? So it doesn't really look that way.
Great. Okay. Tanvee, Jayesh, thank you so much, both of you, for taking the time out and giving us your quick assessments. Really appreciate your time.
Thanks. Bye.
Thank you.
Thank you. And viewers, from Pallavi, myself, and the team that put this broadcast together, thanks so much for tuning in.